Investment avenues. What we learned in the previous session, we had seen there are three pillars of investment which we look before, that is safety, liquidity and return. Students, there is a journey of achieving financial goals. Financial goals are achieved through these financial instruments which are very important. To meet your financial goals, one has to invest into various assets classes. The selection of these asset classes are based on various investor types which we had studied. Here, risk appetite is important, time horizon which you are looking at is important, your current income and expenditures are important, and your liabilities are important. Only then you can decide what risk you can take, which financial instrument you should go. So all these factors needs a deep dive to understand and selecting the right instrument for yourself. On the screen, you are seeing various types of asset classes. It's cash, equity, fixed income, real estate and commodities. We'll go learning all of them in detail in next slides to come. When you compare these various assets in terms of their return potential, volatility in returns, liquidity, can you invest small amount of money, can you invest monthly or yearly, and how is the complexity? The chart clearly indicates in terms of equity, the volatility in returns is very high, liquidity is very high. You can invest in small amounts, of course you can invest in monthly basis, yearly basis, and the complexity is average. So you can see it for equity, fixed income, real estate, commodities and cash. Okay, let us move ahead and understand one by one more about this. Asset allocation changes throughout our life. It could be different when you are starting your career. It could be different when you are having when you are starting your life, getting married, having your kids, and when you are planning for retirement. So the risk appetite, risk profile, your exposure towards equity, exposure towards debt, having cash in your account changes as you pass through these various stages of your life cycle. So it's very different at every stage. Okay. Coming to cash, okay, having cash in your wallet or bank account have cost attached to it. Though it is not visible, there is a hidden cost. Remember we had studied purchasing power of money. It is going down day by day due to this inflation. Hence, the idle cash which is sitting in your bank account is not free, it has a cost to it. Okay. Though the various banks offer you interest rate, it is not enough to beat the rising inflation. So you should invest this money. Now, there are a couple of popular methods. One is having your parking your excess cash in liquid mutual funds. So liquid mutual funds are nothing but debt mutual funds which predominantly invest in debt securities having short-term maturities. Okay, so these maturities could be as short-term as 1 day to up to 91 days. The various classes of investments include treasury bills, commercial papers, certificate of deposits, which have a short duration of return or short duration of expectation of maturity. So these are the various mutual funds which are offered by various fund houses. So one must study them before you put your hard-earned money into it. Equity investments basically can be done in two ways. You can directly invest in market, that is called as direct equity or equity, or you can choose the safest route which many of us or many people choose today is mutual funds. So equity investments, these investments are risky, that is you are buying directly on the stock exchanges. In India, there are two popular stock exchanges, we all know about it. National Stock Exchange, popularly called as NSE, its barometer is Nifty, and Bombay Stock Exchange, popularly called as BSE, and Sensex is its barometer. So direct investment in equities is a bit risky because before you begin, you should first understand the mechanism of market, which is very dynamic. There are various market players which are involved in this entire ecosystem of equity market, and how this market operates, it's something to learn. So if you don't have enough time on your hand, you have study commitments, you have salary commitments, you have job commitments,